Gold, silver, and copper were among the commodities that hit record highs this year. But are there catalysts to potentially push those prices even higher in 2026? Joining us now to discuss, Bart Melek, Head of Commodity Strategy at TD Securities. Bart, always great to have you on the program.
Well, it's great to be back. Thank you for having me.
We got lots to talk about. Let's talk about gold. Is the bull run perhaps not over?
Well, we don't think so. We still think there is, quite a bit of life in the gold bull run. We're expecting, well, we think an average of 4,400 in the second quarter of next year. That high may come a little quicker, but that's a quarterly average. And typically you will see gold trade plus or minus, $200-300 off those levels or above those levels during a quarter. So we could very easily see 4,700, maybe even higher under the right set of circumstances.
Is that what we've been seeing lately? I mean, of course, we hit record high after record high. We had a great run through the fall, and then we seem to be in a bit of a range right now. And I think you had said, don't be surprised to see it move in either direction in that way. Are we sort of like in a wait period before the next catalyst start to move it higher?
I think for now we're trying to consolidate the gains from what has been a fantastic year for gold. We do think that the trading range is probably around, around 3,900 to 4,200 for now, and we're pretty much there. The reality is, after a big run like that, and where we're seeing a four handle for the first time in history, people around the world and North America, of course, investors, traders, central banks, everyone has to get used to this new reality. And if it hits a high, they might very well be tempted to take some profits. We might see some information from the Federal Reserve, like we did, I think now 3 weeks ago, where there was quite a bit of ambiguity or uncertainty of where the central bank might go. You might have a Fed speaker who says that, a December cut is 100%. Other one would say, well, not so fast. We're still having inflation at elevated levels. And for a while there, the probability of a cut in December from the Federal Reserve was as low as, I think, 38%, even a little lower.
And then a week and a half later, suddenly everyone's back on board with a cut.
Right, and that's exactly what happened. So if you have a long position, if you're, a prop trader or just, your run-of-the-mill investor, and you bought in at 3,800 and it suddenly hits 42, and now you're hearing a central bank saying, well, we may not be cutting, and there is that strong inverse relationship between the two. Well, you're very tempted to take some profits, and I think we've seen a lot of that. And on the central bank front, when it hit certain levels above, 4,000, those folks were wondering the same thing. Yes, they might have a long-term program to increase the gold reserve as part of their FX exposure to maybe 25-30%, depending on the central bank. They too might want a better a deal. So we've seen certainly in the market some evidence where some central banks that would have the plan were on a bit of a hiatus when it hit these highs. But once it came back from under 4,000, many traders around the world would see their order books starting to fill up from the official sector. So everybody likes a bargain. Country like India, they're notorious in slowing down their purchases where prices, and silver as well, when they spike. They might want to chill out for a little bit, see where it goes, take some profits. It is my understanding you can't go broke by taking profits, so I think that applies for all asset classes. But the fundamentals are strong, and we see it higher.
Okay, stockpiling, another big theme this year, especially for critical minerals. How does that start playing out in 2026?
Well, much will depend on what the U.S. government is thinking on critical metals and how the tariff story unfolds. We of course know that the tariffs are going to be examined by America's highest court, and it could very well be that they might end up lower. But there might also be a review later in the year, I think in June, where they might double down on some of those things. And I think there is a contingent of traders that think maybe some critical metals like platinum and others, we've seen platinum take off, maybe, protected by tariffs to develop domestic consumption, domestic production. We'll see that goes. That's probably a bad policy, but we're seeing it on aluminum. We're seeing it on steel in the United States. 50%. Ultimately, I think they go down, but there's a lot of uncertainty that others might be encompassed. And what does that do? Well, if I think there's some possibility of tariffs where maybe something that costs $100 will automatically be $150 at some point in time, well, I might just ship it over, hold it in inventory, which would be much cheaper than paying the 50% premium. So I think we're seeing flows of some of these critical minerals into the United States to be put in inventory. We'll see what happens. But the tariffs have been a big positive, and they have upset the whole supply chain dynamics and logic. It is now where we're thinking is that the classical factors of profit maximization and optimization may not really 100% drive all decisions. There is now a new national security component and economic security component that seems to be incorporated in these policies, where I think in North America and the United States in particular, Europe too, you might be willing to pay a bit of a premium for the peace of mind that you're going to have access to the minerals and the critical metals, which right now are dominated by Russia, Russia to some extent as well, by China.
We only have about 2 minutes in this part of the conversation. I know we're going to talk more about it later in the show, but oil. Oil did not join the group of gold and the others in record runs this year. What's the outlook going into 2026?
Well, I think it's going to be, very, very trying times for oil in the first and second quarter of 2026. Big reason, of course, is oversupply. We're really seeing a lot of Latin American supply, some from Canada, and there's that momentum still in shale production, where it's not going down as you would expect based on the price and base where drilling activity is. Demand is going to be firm, but it's not going to be firm enough to absorb that excess supply. I think things improve in the latter part of 2026 when the non-OPEC supplies start, increases start going the other way. China continues to absorb, maybe as much as 1 million barrels per day of oil in its strategic inventories. And I think ultimately OPEC already has said that they will not increase supply anymore. So it might get very tricky and nasty for oil in the first part of the year, but we don't think that will be sustained for all of the year. I think it looks much better in the latter part of the year and into 27.